Implication on corporation earning, Chapter 2. Still Chapter 2. Another highly important approach to the subject is by study of the earning rate on capital shown by American business. This has fluctuated, of course, with the general rate of economics activity, but it has shown no general tendency to advance with the wholesale prices or cost of living. Actually, this rate has fallen rather markedly in the past 20 years in spite of inflation of this period. To some degree, the decline was due this decline was due to exchange of the level deduction rate, see table 222, extent studies have led to the conclusion that an investor cannot, in much more recent 5-year rate on a DJIA group, about 10% of the table's asset book value behind the share, since the market value of these issues is well above their book value, say 900 market versus 560 books in mid-1971. The earning on the current market prices work out only at some 6.1/4%. This relationship is generally expressed in the reverse or time earning manner. That was the DJI price of 900 equal 18 times the actual earning for the 12th month and in July 1971. I'll figure here indirectly with the suggestion in a previous chapter that the investor may assume an average dividend return about 37% on market value on his stock, plus an appreciation of, say, 4% annually, resulting in revised profit. Note that each dollar added to book value is here assumed to increase the market price by about $1.60 or 60 penny. The reader will object that the end of our calculation make no allowance for the increase in our common stock earning and values to result from the project 3% annual inflation. Justification is the absence of any sign that inflation or comparable amount in the past has any direct effect on reported per share earning. In the past has had any direct effect on report per share earning. The cold figure demonstrates that all the large gain in earning of the DJIA until the past 20 years was due to a proportionally large growth of investor capital coming from the reinvested profit. It inflated and upgrade as a separate favorable factor. Its effect would have been increased the value of his previously existing capital. This, in turn, should be increased the value but nothing in its kind actually happened in the past 20 years, during which the wholesale price level has advanced nearly 40%. Business earnings should be influenced more wholesome prices than by consumer prices. The only way that inflation can add up to common stock value is by raising the rate of earning on capital investment. On the basis of the past record, this has not been in the cases. It was the economic cycle of the past, good in business, was accompanied by rising price level and poor business by falling prices. It was generally felt that a little inflation was helpful to business profit. This view is not contradicted by the history of 1950 and to 1970. which reveal a combination of a generally continued prosperity, generally rising prices. But the figure indicated that the effect of all this was on earning power of the common stock capital. Equality capital has been quite limited. In fact, it has not even served to maintain the rate of setting, and the influence would have prevented any increase in real profitable of American corporation as a whole. Perhaps the most important of these have been a rise in the wage rate exceeding the gain in productivity, and two, the need of huge amount of new capital, thus holding down the ratio. What? It is surprising how little attention has been paid by economists and by Wall Street to this development. The debt of the corporation has expanded nearly fivefold, while their profit make before taxes a little more than double. With a great raise in the interest rate during this period, it is evident that the great corporation debt is now so this is table 222. You can actually take a picture if you want. Economic factor of some magnitude and real problem for many individual enterprises. Note that in 1950, net earning before note that in 1950, net earning after interest but before income tax were about 30% of the corporation debt, while in 1969 they were only 13.2% of debt. The 1970 ratio must have been even less satisfactory. In some period that a significant part of the 11% being earned on the corporation equality as a whole is accomplished by use of a large amount of new debt costing 4% or less after tax credit. And our corporation, it had to maintain the debt ratio of 1970. Their earning rate on stock capital would have fallen still lower in spite of inflation. The stock market has considered that the public utility enterprises have been the chief victim of inflation, being caught between a raising a great advance in the cost of borrowed money and difficulties of raising the rate charge under the regulatory process. But this may be placed to remark that the very fact the unit cost of the electricity, gas, and telephone service have advanced so much less than the general price index put these companies in a strong strategic position for the future. They are entitled by the law to change rates sufficient from an antique return on their invested capital, and this will probably process their shareholder in the future. As it has in the inflation of the past, all of the above bring us back from the conclusion that the investor has no sound basis for expecting more than an average overall return of, say, 8% on a portfolio of the DJIA type of common stock purchased at the late 1971 price level. But even if these expectations will prove to be understood by a substantial amount, the case will not be made for an all-stock investment program. If there is one thing guaranteed for the future, it is that the earning and the average annual market value of the stock portfolio will not grow at the uniform rate of 4% or any other figure. And the memorial award at the elder J.P. Morgan, they will be fluctuated. This means for today's common stock by today prices of tomorrow will be running a real risk of having unsatisfactory result. Therefore, from over a period of year, it took 25 years for General Electric and the DJIA itself to recover the ground lost in the 1929 to 1932 decade. Besides that, if the investor concentrated his portfolio on the common stock, he is very likely to be led astray either by accelerating advance or by distressing decline. This is particularly true of his reason of the geared closely to expectation of further inflation, for then if another bull market come along, he will take the big risk not as a danger signal of an inventable ball. Fall as if a chance to catch in a handsome profit, but rather as a vindication of the inflation hypothesis, and as a reason to keep on buying common stock, no matter how high the market level, nor how low the dividends return. That way lies sorrow, alternative to common stock as inflation hedge. We'll read it in the next video. Thank you for coming and have a good day.